Interest rate. An interest rate is the percentage of principal charged by the lender for the use of its money. The principal is the amount of money loaned. Interest rates affect the cost of loans. As a result, they can speed up or slow down the economy. The Federal Reserve manages interest rates to achieve ideal economic growth. What is an interest rate? An interest rate is either the cost of borrowing money or the reward for saving. It is calculated as percentage of the amount borrowed or saved. You borrow money from banks when you take out a home mortgage. Other loans can be used for buying a car, an appliance, or paying for education. Banks borrow money from you in the form of deposits, and interest is what they pay you for the use of money deposited. They use the money from deposits to fund loans. Banks charge borrowers a slightly higher interest rate than they pay depositors. The difference is their profit. Since banks compete with each other for both depositors and borrowers, interest rates remain within a narrow range of each other. How interest rates work? The bank applies the interest rates to the total unpaid portion of your loan or credit card balance, and you must pay at least the interest in each compounding period. If not, your outstanding debt will increase even though you are making payments. Although interest rates are very competitive, they aren't the same. A bank will charge higher interest rates if it thinks there's a lower chance the debt will get repaid. For that reason, banks will tend to assign a higher interest rate to revolving loans such as credit cards, as these types of loans are more expensive to manage. Banks also charge higher rates to people they consider risky. The higher your credit score, the lower the interest rate you will have to pay. Fixed versus variable interest rates. Banks charge fixed rates or variable rates. Fixed rates remain the same throughout the line of the loan. Initially, your payments consist only of interest payments. As time goes on, you pay a higher and higher. Initially, your payments consist mostly of interest payments. As time goes on, you pay a higher and higher percentage of the debt principal. Most conventional mortgages are fixed rate loans. Variable rates change with the prime rate. When the rate rises, so will the payment on your loan. With these loans, you must pay attention to the prime rate, which is based on the federal funds rate. With either type of loan, you can generally make an extra payment at any time towards the principal, helping you to pay the debt off sooner. How are interest rates determined? Interest rates are determined by either Treasury note yields or federal funds rate. The Federal Reserve sets the federal funds rate as the benchmark for short-term interest rates. The federal funds rate is what banks charge each other for overnight loans. Impact of high versus low interest rates. High interest rates make loans more expensive. When interest rates are high, fewer people and businesses can afford to borrow. That lowers the amount of credit available to fund purchases, slowing consumer demand. At the same time, it encourages more people to save because they receive more on their savings rate. High interest rates also reduce the capital available to expand businesses. Strangling supply. This reduction in liquidity slows the economy. Low interest rates have the opposite effect on the economy. Low mortgage rates have the same effect as lower housing prices, stimulating demand for real estate. Savings rates fall when savers find they get less interest on their deposits. They might decide to spend more, they might also invest their money into slightly riskier but more earnable or profitable investments, which drives up the stock or the share prices. And yes, don't forget to subscribe to the channel for future learning. Thank you.